So moving on, we're going to proceed to the next panel discussions, AI Investors Circle, From Vision to Victory, Scalable, Sustainable Journey to Unicorn Success. So now I would like to first invite the panel chair to come up on stage. May I please invite Mr. Johnny Chen, Chief Investment Officer, Hong Kong Cyberport. Let's welcome Johnny. And our panelists including Mr. Thomas Tsao, co-founder and chair, Gobi Partners. Welcome. Let's welcome Thomas. And next, let's welcome Mr. Vinod Kumar, Vice Chairman of Everstone Capital Asia and CEO of Evercloud. Welcome. And last but not least, let's welcome Mr. Joe Yan, partner and co-head of Granite-Integral, Granite Asia. Let's give them a big round of applause and welcome our panel chair and panelists. Let's welcome Johnny.
Thank you. I think at almost 4 o'clock, we still have about 2/3 of the people here. It's actually not too bad. Okay, so I know that some of you are falling asleep. I know that some of you are looking at your phone, which is still okay. But I'm going to give you a chance to stretch yourself. So if you would like, stretch yourself a little bit, stand up, stretch yourself. And if you see that your neighbor is falling asleep, there are free coffees out there. Then go and get them coffee and be invigorated. Okay, so we're coming to the second last panel. About unicorns. So I want to show you some figures that, with the view of scaring you first, so how difficult it is to become a unicorn. So first of all, we're talking about reaching unicorn status. It's less than 1 in 1,000. Okay, this is based on the US figures, National Venture Capital Association figures. Average time to reach it is about 6.5 years. The fastest one now, because of AI and because of the advance in tech, some unicorns reached unicorn status quicker. This is a statistic that actually me and my panel are actually not sure whether it is correct. 20% of the startup that became a unicorn actually failed. I think the number is probably higher. I personally have seen some of that. And then the rest are basically just some numbers. But to put into perspective, I did a little bit more research. There are about 1,500 unicorns, I think we all agree, 1,600 unicorns around the world. Most of them are in the US. Second largest unicorn raised would be in China. But if you compare unicorns with endangered animals, like our big panda. So it's 1,500 versus about 1,800 living pandas in the world. So unicorns are rarer than pandas. Another one that I thought would be even rarer, which is the snow leopard. I haven't seen a snow leopard in my life, but snow leopards actually are more. There are about 4,000 snow leopards in the world. So unicorns less. So it is a very rare species, unicorn. Okay, so after scaring you guys, then I think there's of course a ray of hope. Venture capital is all about hope going forward. What I've managed to curate here are our fellow venture capitalists. Each of them have either helped, nurtured unicorns, so I want them to share the stories. All of them have actually also experienced the fall of the unicorns. They may not want to talk about that, certainly don't want to mention names, but both the rise of unicorn and the fall of unicorn, or companies that in their experience have actually almost reached unicorn or actually having reached unicorn, but then did not make it in the end. So what I want to do, instead of talking about theory, what you should do and the list of critical success factors, I want them to share with us some of the life experience from their experience. It could be from their current portfolio, it could be some of the past experience. So maybe I will start with you first, Tom. a quick introduction of yourself. Veteran venture capitalist in China and now the rest of Asia. You are managing a number of funds, including the Alibaba Entrepreneur Fund. So yeah, off to you. One example.
Yeah, no, first of all, I want to thank everybody for staying with our panel. We're going to try to keep it entertaining, as Johnny has said, and I think you've already started off a great way. Delighted to be here. So stories, right?
Yep.
I like stories.
Okay.
I think for those of you who know. Look, I think, first of all, not only is, helping a unicorn is very rare, at least in our case, it can take a long time. So I'll just share one case. I think we can talk about it now. So there was a case, and we exited. And I remember we invested into this company before my son was born. The good news is the company has gone public, and we can talk about that. But the more interesting question is you should ask me, how old is your son, Tom? So someone asked me that.
How old is your son?
Yeah, okay. My son is now 17. So we invested into this company before he was born, and then we finally exited. He's 17. So when they say early stage venture capital is, patient capital long term, it really is. It took us 17 years before we got an exit. Now that company is in the semiconductor space. Mm-hmm. Okay? And so that's why, as I think back now, the government, remember there was a time when the Chinese government was like, hey, listen, venture capitalists, you're really not focusing on innovation. You're just focusing on raising a lot of money for business model innovation. I kind of got that. Because if you really want to do deep tech innovation, sometimes it just takes a long. Semiconductors take a long time. That's one part of the story, and then we'll let others share.
Great. Yeah. I actually have one to match. 16 years, 1 year less than you, in China. I started that company with 2 partners. We went through 6 CEOs. Yeah. We went through dips. We tried to sell the company. And decided not to. And then we managed to list it 2 years ago in Hong Kong. So that is a very long but happy exit. Yeah. Vinod?
Okay. I'll give a slightly non-Asian perspective if that's okay.
Please do.
And not necessarily in AI. 2 examples, and I want to draw lessons from both, right? And it hasn't been 17 years, but between 8 to 9 years before they achieved unicorn status, and since then have gone past it. Both are privately held still. One is in the fintech space. It's a digital asset bank that is headquartered dually between Switzerland and Singapore, and the other one is a visual AI company that's based out of Israel. When I look at both these companies, there are 2 lessons that I extract, and I'd like to share with you. I'm a personal investor in both, and also sit on the board of one of these entities. The first one is the management team emphasizes more on deep problem solving rather than storytelling. And this is something that I really watch out for every time I talk to any founder, is if they're so absorbed with their story, which you want a founder to be, but if they're thinking more about the narrative rather than the action plan, it's a big red flag. Another one is if there's an overemphasis in the conversation that we have with them on valuation and multiples and benchmarks, it again is a big red flag for me. If the passion is around the problem they're trying to solve, the ideas they have to solve it, and the ideas don't need to be concrete, and we're talking about early stage, but if the passion and understanding they show off, that for me is very important. So in both these platforms, I would say the management team really showed a lot of maturity on emphasizing how they were going to execute and not just tell their story. Of course, as an early stage business, you need to be a good storyteller. I'm not saying no, but if that's the emphasis and not the problem solving, it usually fails. The second takeaway for me is we talk a lot about founders and the teams, but I think to guide a business from early stage to growth stage and then successful unicorn and post that, the role of the board is super important, especially at times when things are going really well. Okay, and I'll explain that more. So when in the visual AI company, they started off doing visual AI before the AI hype. Then, frankly, the valuation could be 3 times what it is right now if they talked it up. But the board always kept them really mature and not greedy and focused on long-term value creation rather than riding the immediate wave. So I think there's a board role there. The other case, they're a digital asset bank, very much tied to the crypto world in a way, custodian for crypto assets, and we do lending against digital assets and so on. And the board composition, and we can elaborate on this, for me is super interesting. The management team are deep tech, libertarian thinkers, believe that crypto is the only way the world can survive. But the board that the management team assembled, the founder CEO assembled, is a bunch of old dudes like me, who come from traditional banks, who come from insurance, or proper CFO experience. So they constantly manage risk. So when I look back at the journey, there were times when our peer group was all just taking off because they were just really riding the Bitcoin wave and the story, and we kept playing a moderate, straight middle of the road game, managing risk very well. I think when we look back at where we are and everyone around us who actually has collapsed or collapsing, it really tells how board composition and the role of the board, especially when things are going really well, is very important.
Good. Well, at least they listen to you. Some don't listen to the boards. I have that experience too. Joe?
Yeah, great to be here. I'm Joe. So thanks, Johnny, for hosting us. So Granite-Asia, we formerly known as GGV Capital. With the over 25 years, investment in the tech space, actually we had over 100 unicorns, right? So in our portfolio companies. So that's actually we oftentimes, right? So we was joking within the firm saying, hey, it's a blend of genius, right? Timing, right? Also luck. Probably luck is the most important thing, right? But today we are not a fortune telling session, so we are not talking about the luck. So put the luck on the side, but actually we have seen a lot of the patterns. Right, so how actually the company can really become a unicorn, right? So probably I will break it down to 3 different phases, and with some of the real examples, right? So I think the number one, the phase 1, is about the product market fit, right? So building the product, building the unicorn, is not always about the disruptive innovation, right? Sometimes it's about very unsexy revolution. Right, so it's how actually you can really transform the foundations, right? So I give you an example, right? The one company called Slack, right? So probably a lot of you guys are using Slack. Actually, that's a company actually we invested in the States in the early days, many years ago. But actually, back to the time actually when actually they came out, but there are already a lot of communication messaging apps, right? But probably people really know Slack actually came out when then actually there's just a internal communication app in a gaming company, right? So, but it's not about the chat, right? So why actually Slack can be successful is about transforming, or it's kind of fixing a lot of organizational friction. Right, I think that's the real problem. Actually, they address and they help, and that's the reason why actually they become very successful. Right, and now actually in this AI era, I mean, the product market fit is not just the DAU. It's not just actually how many users you have. Right, I think probably I have a little bit different view from the previous panel. Right, I think in this AI era for AI company, I mean, probably you ask me, I think revenue, the ARR is more important than the DAU. Right, because the large language model come out, actually a lot of application they build on top of the fundamental model, right? Actually building the application became easier than before, right? And the users shifting cost, right, become lower, right? And how you prove your real product market fit, I think it's about the revenue, right? How the willingness actually, the user, the customer want to pay, for your application. I think that's important, right? Sometimes the hype is actually you saw, oh, I have a lot of users. But when you start monetization, and then all the users are gone, right? And then not something, actually, that I think that's something bear in mind, very important. I mean, phase 1, product market fit. Phase 2, I think it's just like Vinod mentioned, I think it's about the, the scaling. Right, the scaling. How actually you can really transform your company, transform from the product to a company. I think that's important, right? And early stage, I mean, oftentimes the company is a more founder kind of led growth or founder driven, right? But you cannot do everything as a founder or CEO, right? Probably the day one, day two, you can be the CTO, CEO, CFO, right? But at some point, I think how you really can upgrade the team, bring more kind of talents, right, into the team. I think that's become very, very important if you really want to grow to a unicorn, right? I can give another example. It's about our another portfolio, Didi, right? So actually the founder, CEO, Chen Wei, personally, actually, we are good friends. By the way, I knew him since actually, he was still, at Alibaba, right? But I saw how actually he really evolved himself, right? How he actually upgrade the team, right? And then you see actually that's a tremendous, growth, right? In the first few years of when actually Didi, become the unicorn. I mean, in China, right? Last but not least, the phase 3, I think it's about the evolution, right? I think that's about actually, the sustainable growth, right? A lot of company, I think Johnny mentioned, like 20% of the unicorn still fall, right? So after they become the unicorn status, but I think that most of the company who have seen that fall is actually they cannot build a sustainable kind of a business model, right? And a lot of them actually probably spend 80% of the time or 80% of the resources focusing on the user growth, right? That's not right, right? I mean, probably 80% should be still on your product, how you iterate your product, how you really keep improving, optimizing, the customer experience, right? And I mean, the user growth, the growth will be an outcome, will be a result, right? And I think that's very important. But we also have some of the billion-dollar lesson, but I'm not gonna name the company anyway, right? So I think they grow tremendously, right? But actually, the company, you found actually the engine, it's about user growth. Right, very good at the marketing, right? The marketing, the hacking, technology, whatever, right? But at the end, actually, if you cannot, fix, the fundamental, business model issue, right? Let's say the supply side, right? How you really can provide a good product, how you really get the retention. I think it failed anyway, right? So yeah, so I think that's probably.
Thank you. Joe, you mentioned team. I think team building is important, particularly when you scale to a certain level. Right? And the type of people they bring in, I think culture is one. And the founders obviously find that it becomes almost like a human resource officer, interviewing people. But with the size of a company like that, they are also firing people, letting people go. Yeah. So we found that founders spend a lot of time dealing with that. Yeah. So do you want to talk to that as either a success or somebody who actually didn't manage to do that well and therefore fail the organization? Mm-hmm.
Yeah, definitely. I think that's also, I mean, that's a human nature, by the way, right? So, I mean, as a person, I mean, we like the kind person, right? But actually, by nature, actually, they're very hard, right, to really kind of let go some of the early members, right? But I think as an investor, what we do here is actually definitely we want to become actually the friends and the trusted friends, right, to the CEO, the founders, right? And actually, we give them a lot of advice, right? And actually, we also talk to, those guys. Probably it's not capable, cannot catch up, the growth of the company, right? And help the founder to fix that kind of emotional part, right? And also, actually, probably compared to many other, VC or growth equity firm, one thing actually we build as a cutting edge, I mean, it's on the competitive edge, is our value creation platform, right? So we have this talent team. So we have the people, right? So actually can really, work alongside, the company, right? So actually we give them a lot of organizational kind of building advice all the time, right? And also actually help them to find, the right people to upgrade the team, right? So yeah.
You have something that you like to share on the human management in some of the cases?
Yeah, I think it's equally important whether it's in the venture stage or in the private equity world, which is where we're mostly focused. When you're taking a business which is 100, 150 million in revenue to the 300, 400 million, that's a very tough transition because the team I'd say 50% of the time, the team that brought them to that stage won't scale, or 50% of the team will have to change roles or be phased out. And the board can play a role, and I think establishing that trusted friend, trusted advisor role helps. But again, it's a bit of a balancing act. The board is playing a certain role, driving them on numbers. What is your value creation? Giving the formal value creation plan. That it's a very personal thing for the CEO then. And where we found it helps is when we have a panel of external advisors who are more like a coach to the CEO rather than the formal board. Now, ideally, you want the board members to have that equation, but when that doesn't happen, the board can rely on those who can just coach the CEO from outside.
Right.
It's super important because this is where businesses actually
Right.
fail.
Thank you. Well, I mean, we don't have a lot of time, but Thomas, can I ask you to talk to pivoting? Like some businesses get to a certain point and then they pivot. I have an example of that. The company pivot 3 times and becomes very, very successful. So do you have something that you would like to share about pivoting the business?
Yeah, no, I mean, I think a good example is a company, since Hong Kong we're having FinTech Week right now, is when we were very fortunate. We were an early investor into a company called AirWallex, and I'm sure you guys have heard about it. Yeah, and they started off they saw an interesting problem to solve, which was mainland Chinese students studying in Australia couldn't pay their college tuition bills. Right? How do you move the renminbi and to pay off the Aussie dollars? I mean, it was something as simple as that. Jack and Lucy decided we're going to try to solve that, and it's a very interesting story, right? Because they're mainland Chinese students in Australia. When they tried to raise from the Australian VCs, the Australian VC said, "You're not Australian, so we can't invest." They came back to China. The China VCs were like, "Hey, you're not operating in China. You're not a Chinese company." And so then they came to us, and we're just like, "Well, this is kind of where we play, right? Kind of in between, where it's not really." And we're like, "This is a great company. Let's do that." But they've made a number of pivots, right? They started off doing something that was very simple, and then I think as they continue to evolve, right? They're building out now the rails. I still have a slight disagreement with Jack. I think he's going to have to do something with stable coins, but that's a whole different story. Okay. But I think the way they've pivoted is they've started off with something very simple and then continue to add and add and add on top of that. So I think that's an example of one.
I think they're about I think the last round was about 5 billion or something, right?
There may be news about something coming up. Yeah. I won't say more on that, but okay. Yeah.
Well, they're big.
They're big. I think the last round publicly was like 6.2.
Yeah. Okay. Well, so I short.
But for everybody here who stayed with us, I'm going to give you something. Look for there may be news. There could be something very good coming up in the next. Okay.
So that it is a true unicorn. And then in my case that I like to share is that this is a very long time ago. I invested in the company. They were basically a portal, a news service. Actually got into trouble because the advertising business is bad, and then they pivoted into SMS. And I did ask the CEO one day, I said, "How can you make money? I mean, you make 1 cent renminbi per SMS." And they said, "Johnny, you're so wrong. We make 50 million SMS every day, and then it becomes 100 million SMS, and it becomes more." And even that, they then pivot again. 3rd time, they pivot into games. And then now they're the 2nd largest game player in China.
Johnny, so, can I just add something? One is, pivot. The other is, especially in the AI world today, is narrowing your focus, right? We're finding that especially those who are building agents and some of the foundational, the models, start with a fairly broad remit, right? But that's a bit of a dangerous territory because you could wake up one morning and OpenAI or Llama could just release what you think is a product as a simple feature and you're wiped out. And that's happening every day. So what we are recommending our portfolio companies to do is to, go broad, understand where you get the most traction, but build domain expertise and vertical knowledge as quickly as possible. So the intersection of domain knowledge or vertical expertise with the deep tech on the AI side is where value can get created. So pivoting is one, but I think in the AI world you probably see it a lot is when do you sort of double down on certain bets and bring focus?
Sure. Well, actually, I think this is my final question. I mean, with the rapidity of companies becoming larger and larger, companies staying private a bit longer. The capital requirement is longer. I know that all of us, play with the early stage all the way up to maybe even C, but then some companies require very large tech. I mean, a few hundred million. In fact, one of the companies that I've got involved just raised 800 million. The entire fund cannot put into. So can I ask you to maybe comment a bit on how these different layers of capital can be supported? And I think it is through an ecosystem of larger funds, working with larger funds to support our portfolio companies.
You want to go first?
Well, I mean, I'll take a first stab and I'll turn it over. I mean, look, I think, the way the capital, venture capital, private equity is stacked, I mean, I view the role as, it's just like, hey, I think there are some teachers that are great at the elementary school level, right? But they may not be the best when they're high school level. I think early stage VC, when I think about it that way, is our job is to be the best, when companies are younger, and be the best teacher we can be there. But as the company gets bigger, they got to graduate. There's other guys, right? Like the PE guys here, Joe here, right? We got to hand them off. I know in venture there's there's a term now where everybody wants to do like buffet PE, right? Because you just want to offer multiple products and just get market share of the wallet from big LPs,
Crossover.
right? And that's great too. I think some firms are doing a great job at that. And like at Gobi, I got team members always going, how come we don't get more management fees, right, Hazel? Right? So yeah. So, but again, it's just what do you want to do? You can be kind of like a buffet and offer everything. I think at Gobi, we want to be very focused. Now, of course, the definition of early stage for us has also expanded. We're now going from pre-seed, and we go up to C. And in order, we'll do SPVs as well because you want to maintain that. But my view is you want to, every firm, if your competitive advantage is to focus on one part of that kind of life cycle, you want to work with other great partners as companies get bigger because you're right. When you're going for a public listing, there are other skills. And so for us, it's very collaborative. You want to work with the entire ecosystem, and then as the company reaches a certain stage, we think there are better teachers, coaches, that then you hand them off to.
Can I give you 1 minute to talk to that, and Joe?
Yeah, I would agree with that. To a certain extent, when you have multiple funds being launched, you have some opportunity to roll things over. But I agree that it's very, very different skill set that we bring. It's also what the business and the management team require. So it's better to swim in your lane, I think.
Okay, Joe?
I'll just make it very quick. I think it's about the ecosystem, right? So I mean, in the US and Asia, I think very different, right? I mean, in US, I think more mature, right? You see, the early stage, you see a lot of growth stage, and you see a lot of private equity guys launch the growth equity fund, actually can support 500 mil kind of check size, right? But in Asia, oftentimes, I think people probably still, about, the early and the growth stage. Actually, let's say, we are typical in a multi-stage investment firm, right? So we have the early stage discovery fund, and also we support the growth and later, right? The check size can be, ranging from 15, 20 million all the way probably up to 100 mil something, right? But in Asia, I think you need to find, if you really want to find 500 mil, probably it's more strategics, right? So it's more strategic, investors, right? So in this field. But anyway, I think again, right? So I think overall, I think I agree what Tom mentioned. I think people have their own expertise. They have their own sweet spot, right? From the investor perspective, right? And I think the company come to a certain stage, you need to find the right money from the right investor. I think that's the key. Yeah, but in US, probably also interesting, you see, the convention, between the VC and the PE, right? All these guys are light speed, general catalyst, right? Yeah. So they go up, right?
They want to take all the fees, right? You got to save some for everybody else, right?
That's right. Well, I think we are time's up, but we could talk for another hour. But thank you for listening, and thank you for paying attention to this session. Thank you all, and thank you, my fellow panelists. Thank you.